David is 47 years old, senior VP at a financial institution in the CBD. He earns $22,000 a month. He owns his condo in District 10 outright. He owns a second unit in Tampines that he rents out for $3,200 a month. Last December, he sat down to calculate what his second property actually earns him net. He had not done this since he bought it 4 years ago. The rent, $3,200 a month, $38,400 a year. Then he subtracted property tax. His Tampines unit has an annual value of $31,000, which means it is taxed as a non-owner occupied property at progressive rates starting at 12%. His property tax bill, just under $4,000 a year. Then management fees. Then maintenance. Then the years with vacancy. His net yield was 3.1% on the purchase price. Then he remembered the ABSD he paid when he bought it. 20% on the $1.2 million unit. $240,000. Paid up front on day one, before the property earned a single cent. He had not made a mistake. He had made a decision that was completely standard for a Singaporean investor in his income bracket. But he had been calculating his return the wrong way for 4 years. He had been ignoring the taxes he already paid to get in the door. Singapore does not have a wealth tax. It has something more sophisticated. It has a system of property taxes, stamp duties, income surtaxes, consumption taxes, and vehicle levies that have been quietly tightened, consistently, incrementally, deliberately, for a decade. And in Budget 2026, Prime Minister Lawrence Wong stood in Parliament and said, "The government will continue to study how it can strengthen its current system of wealth taxes." He used those exact words: strengthen, current system, wealth taxes. This is not speculation about what might come. This is a map of what is already here, what it is already costing people like David, and what every Singaporean with assets above the median needs to do before the next tightening arrives. Start with a number that most people earning above $10,000 a month got wrong in their 2026 tax filing. In Budget 2022, when Lawrence Wong was still Finance Minister and DPM, Singapore raised the top marginal personal income tax rate from 22% to 24% on chargeable income above $1 million, effective from Year of Assessment 2024. The move was explicitly framed as a progressivity measure. It affected the top 1.2% of personal income taxpayers and generates approximately $170 million in additional revenue every year. Most people above that threshold were aware of the change. Fewer noticed what happened for everyone else in YA 2026. For Year of Assessment 2025, IRAS provided a personal income tax rebate of 60% of tax payable, capped at $200. It was not large, but it existed. For Year of Assessment 2026, meaning income you earned in 2025, which you filed in 2026, that rebate was not renewed. No announcement, no headline. The rebate simply did not appear in Budget 2026. The effect? Every Singaporean who pays income tax is paying more in YA 2026 than in YA 2025. Not because rates changed, because a cushion was removed. Grant Thornton Singapore noted this directly in their Budget 2026 briefing. Without the rebate, individuals will be subject to a slightly higher rate of tax in YA 2026 than in YA 2025. This is the pattern, not a single dramatic hike, a series of small, defensible, incrementally compounding adjustments that individually sound reasonable and collectively constitute a meaningful shift in how wealth is taxed in Singapore. The action here? Log into MyTax Portal and review your YA 2026 chargeable income. Check whether you have fully maximized the only real levers available, the $80,000 personal tax relief cap. CPF cash top-up of $8,000 to your own retirement account gives you $8,000 of tax relief and 4% guaranteed returns. SRS contribution of $15,300 gives you another $15,300 of tax relief and gets invested in CSPX or Singapore REITs before the December filing deadline. These are legal, government-sanctioned tools. They exist specifically for this purpose. Now the property system. This is where the wealth redistribution is most visible, most deliberate, and most consequential. In 2013, the top marginal property tax rate for an owner-occupied residential property in Singapore was 6%. By January 2025, following the two-tranche increase announced in Budget 2022, that rate had risen to 32% on annual values above $130,000. The top rate for non-owner-occupied properties, investment properties, rental units, any residential property you do not personally live in, reached 36%. The Ministry of Finance's own language in announcing these changes described them as wealth redistribution measures. Let us make that concrete. If you own a two-bedroom condo in Pasir Ris, rented out at $2,600 a month, IRAS sets your annual value at approximately $31,200, 12 months of that rent. Your non-owner occupier property tax on that unit, around $3,840 a year. That is more than a full month of rental income paid to IRAS before you receive a single dollar of net rent, before maintenance, before vacancy periods, before mortgage interest if you still carry one. For a $3 million condo with an annual value of $67,500, owner-occupier property tax is approximately $2,950 a year. If you rent it out instead, same property, same walls, same address, the non-owner occupier bill jumps to approximately $13,500 a year. The Ministry of Finance is not hiding its intention here. Investment properties should contribute more to the fiscal system than primary residences. That principle is baked into every tier of the schedule. In 2026, the government provided a one-off property tax rebate. 15% for HDB owner-occupiers, 10% capped at $500 for private property owner-occupiers. For a private condo owner paying $3,000 in property tax, the rebate saves $300. It is meaningful for lower value properties and negligible for higher value ones. It is also explicitly a one-off. There is no indication it will be repeated for YA 2027. The action. If you own an investment property, calculate your actual net yield right now. Take your annual rental income. Subtract property tax at the non-owner occupier rates. Subtract maintenance fees, management costs, and a realistic vacancy allowance. Divide by the current market value of the property. If that number is below 3%, compared to what the same capital would generate in CSPX at 7% average annual returns, or in Singapore REITs at 5 to 7% dividend yield through SRS, with no property tax, no ABSD, and full liquidity. This comparison does not tell you to sell your property. It tells you to be honest about what you actually own. The stamp duty system is where the largest single transaction wealth tax in Singapore lives. Additional buyer's stamp duty rates were last revised on 27th April 2023. They remain in force in 2026. For a Singapore citizen buying a second residential property, the ABSD rate is 20% of the purchase price or market value, whichever is higher. Third and subsequent properties, 30%. For permanent residents purchasing a second property, 30%. For foreigners purchasing any residential property, 60%. On a $1.5 million condominium purchased as a second property by a Singapore citizen, the ABSD alone is $300,000. Add buyer's stamp duty, approximately $54,600 at current tiered rates, with the top tier of 6% applying to the portion above 1.5 million. Total stamp duty before the property earns anything: $354,600. This money does not compound. It does not come back if the property declines in value. It earns no interest while it sits paid. It is a flat cost that must be recovered entirely from appreciation or rental income before the investment breaks even. At current non-owner-occupier property tax rates and realistic rental yields, the mathematics of holding a second residential property in Singapore have become significantly less attractive than they were 3 years ago. They were not designed to be attractive. They were designed to moderate demand from investors so that genuine owner-occupiers could compete in the market. The question for anyone currently holding a second property or considering one is not whether Singapore property appreciates. It does. The question is whether the post-tax, post-ABSD, post-property tax net return justifies the capital locked in compared to alternatives, and whether the trend in all three of those costs is improving or worsening. The trend is not improving. The action. If you are currently holding a second property and have not remodeled the return since 2022, model it now using IRAS's current rates. If you are considering a second property purchase, include the full ABSD and BSD in your break-even calculation. Speak to a tax advisor before signing any option to purchase. The 14-day payment window for stamp duty after signing gives you almost no time to discover a structuring problem after the fact. Now the car. This is the most visible and politically tolerated wealth extraction mechanism in Singapore. Tolerated because the narrative is environmental and because the people who bear it chose to enter the system. So Category A closed at $126,009 in the first bidding exercise of June 2026. Category B, $126,989. Vehicle quota premiums for 5/2026 are estimated to reach $9.42 billion, an 8.8% increase over 5/2025. Motor vehicle tax receipts are projected to rise 17.2% to $2.8 billion in 5/2026, partly because the electric vehicle early adoption incentive rebate ends on 1 January 2027. Budget 2026 made one structural change to the car ownership calculation that has not received enough attention. The PARF, Preferential Additional Registration Fee, rebate was reduced. The PARF is the incentive to deregister a car before its 10-year COE expires. For a 9-year-old mainstream SUV, the PARF rebate dropped from over $8,500 to approximately $900. For a luxury vehicle in the same position, from $44,000 to approximately $4,000. Nicholas Wong, CEO of Car Motor, said publicly that this change is counterintuitive. The PARF existed to encourage vehicle turnover, which generates new COE demand and keeps the system liquid. By reducing it, the government has created a structural incentive to renew existing COEs rather than buy new vehicles. Owners whose COE is expiring now face a calculation where renewal is often cheaper than replacement, especially when new vehicles start at $160,000 all in before any premium model premium. Fewer new purchases means fewer new COE bids in the short run, but it also means the government has already budgeted for $9.4 billion in COE revenue, creating a fiscal dependency on sustained high premiums that structurally limits any future COE price reduction. For anyone currently owning a Category B vehicle, the 10-year decision now needs to include the real PARF value at renewal versus the cost of a new vehicle. For anyone considering a first car purchase, the total ownership cost over 10 years, depreciation, insurance, road tax, parking, petrol, servicing, runs between $200,000 and $300,000 for a mid-range sedan at current market conditions. At 7% annual returns over 20 years, $200,000 invested in CSPX becomes approximately $774,000. The action. Run the number before the next car decision. Not just the monthly payment, the full 10-year total cost. Then run the same capital invested. Then decide. There is one layer of the new tax architecture that affects almost nobody in this channel's audience directly, but that every business owner or senior professional working for an MNC should understand because it is reshaping Singapore's corporate landscape and has already begun affecting hiring, incentives, and business structure decisions. Pillar 2. The OECD's Global Anti-Base Erosion Rules. Effective in Singapore from financial years beginning on or after 1st January 2025. The rule is straightforward. Multinational enterprise groups with annual consolidated revenue of 750 million euros or more must pay an effective tax rate of at least 15% in every jurisdiction where they operate. Singapore's headline corporate tax rate is 17%, above the floor, but the effective rate, after all incentives, exemptions, and rebates, can fall below 15%. When it does, the domestic top-up tax kicks in, and Singapore collects the difference, rather than letting another jurisdiction do so. The practical consequence? Companies that have historically used Singapore tax incentives to achieve very low effective rates will now pay more. The incentives still exist. Pioneer incentive, development and expansion incentive, IP development incentives. But they no longer produce the tax savings they once did if the resulting effective rate falls below 15%. Budget 2026 confirmed Singapore is continuing Pillar 2 implementation while developing new non-tax tools to maintain its competitiveness as an investment destination. Corporate tax collections for revised FY 2025, $35.24 billion, 7.9% above the original estimate. Projected FY 2026, $37.77 billion. Pillar 2 is contributing to this structural revenue increase. For business owners thinking about corporate structure, the era of effective tax rates well below 15% through Singapore incentives is narrowing. The conversation with your corporate tax advisor has changed. The bigger picture is this, and it matters more than any single rate or rebate. Prime Minister Wong stood in Parliament on 1st March 2026 and said three things that belong in this conversation. First, about 1 in 3 resident workers in Singapore pay no personal income tax. Among those who do, around 8 in 10 have an effective rate of less than 6%. The top income quintile receives 20 cents in government benefits for every dollar they pay in taxes. The middle quintile receives $2. The bottom quintile receives $7. This is not a coincidence. It is a deliberate fiscal design, and it tells you clearly which direction the pressure on higher earners is moving. Second, government spending in Singapore could exceed 20% of GDP before 2030. It was 15% a decade ago. Healthcare spending alone is projected to rise from $11.3 billion in 2022 to approximately $27 billion by 2030. The old age support ratio, working age residents per elderly resident, falls from 4.7 today to approximately 2.7 by 2030. Someone has to pay for this. The question is, which mechanisms will be used? Third, on the question of wealth taxes specifically, we will continue to study how we can strengthen our current system of wealth taxes. The government has also noted that many forms of wealth are mobile, and as long as differences in wealth tax rates exist across jurisdictions, mobile wealth will move. This is the constraint on how far Singapore can push. but it is not a commitment to stand still. The analysts who follow Singapore fiscal policy closely point to the most likely next moves as refinements to existing mechanisms rather than new taxes. More progressivity in property tax bans. Incremental increases in ABSD rates for multiple property holders. Potentially revisiting how property gains are treated, especially for HDB and EC units that benefited from government subsidies. The OCBC chief economist has said publicly that an inheritance tax structured with high exemption thresholds to protect middle-class home equity is not off the table in the medium term. None of this is certain. All of it is directional. Sarah is 39 years old. She earns $11,000 a month. She owns her HDB in Clementi with her husband, 4 years into a 25-year mortgage. She has $85,000 in a brokerage account. She has never owned a second property. She has an SRS account with $9,000 in it, sitting in cash at 0.05% interest. She watches this video and thinks, "None of this applies to me. I only have one property. I do not own a car. I am not an MNC." Here is what applies to her. The SRS money is losing value in real terms every year. It earns 0.05%, while inflation runs above 2%. $15,300 invested annually in CSPX through SRS at 7% average returns over 25 years becomes approximately $1,020,000. The same amount in cash at 0.05% over 25 years becomes $382,500. The difference is $637,500. Not from a better investment strategy, from moving money from one account type to another within the same SRS wrapper. The $85,000 in her brokerage account, she currently holds it in VOO, the American domiciled S&P 500 ETF. Every dividend she receives is subject to 30% U.S. withholding tax. If she held CSPX instead, the same index, the Irish domiciled version, the withholding rate is 15%. At her current portfolio size and a 2% dividend yield, she is paying approximately $850 more in tax every year than she needs to. Over 25 years at 7% compounding, that differential becomes approximately $58,000. The system is not coming for Sarah the way it is coming for David, but the system is already extracting from her in ways she has not noticed, and the direction of all the mechanisms she has observed in this video is not toward less extraction, it is toward more. The action is the same for both of them. It is not to panic about future taxes. It is to maximize every legal structure that exists right now before the rules change further. CPF retirement account top-up to the $8,000 relief limit. SRS to $15,300, invested, not sitting in cash. CSPX over VOO for international equity exposure. Review every investment property against its real post-tax yield. Understand what your car actually costs across 10 years. The best response to a tax system that is tightening is not to find ways around it. Singapore's enforcement is thorough, and its anti-avoidance rules are robust. The best response is to use every tool the system itself provides before those tools are also tightened. David ran the numbers again, this time with everything included. His Tampines rental property, 3.1% net yield after property tax, maintenance, and vacancy. The same capital in Singapore REITs through his SRS account, 5 to 7%, tax deferred, without ABSD, without monthly maintenance calls, without the ABSD he paid to get in. He did not sell the property, but he stopped planning to buy a third one, and he opened an SRS account the following morning. Singapore does not have a wealth tax. What it has is a system that taxes the decisions wealthy people make. The car, the second property, the extra income above the threshold, while leaving open every structural advantage that allows you to build wealth through the instruments the government itself designed. CPF, SRS, tax-efficient ETFs, Singapore REITs. The question is not what they are going to tax next. The question is whether you're using everything available right now. PM Wong used the phrase, strengthen our current system of wealth taxes. The current system is already here. It has been tightening for a decade. The next tightening will not announce itself. Are you ready for it?